Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future. Good afternoon. No, it's still morning. I'm corrected. Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnino with NinjaTrader. It is Wednesday, August 16th, 2023. We have a very distinguished guest with us today, joining us live. Jimmy Iorio is with us live in the studio. Good morning, Jimmy. How are you?
Good. I'm not sure distinguished is the right way to say it for me. I don't feel very distinguished, but thank you.
Well, you're distinguished in my book anyway. Okay. I don't know.
Yeah.
Thanks for being here with us. It's interesting times we're living in, for sure. We're living in interesting times as we're kind of maybe we're transitioning from this high inflation era to a low inflation era, with interest rates maybe stabilizing. What do you think?
I think, here's what I think. And I wrote a Substack on this about 3 weeks ago. I think we are entering into a period of severe disinflation, and it's going to eventually lead to a period of deflation. I think we had the highest, the most rapid rate rise, I think, in history, or at least in the last 45 years since Paul Volcker did it. But it's not being felt by the market, and I think there's a real live reason for that. The 5 years that preceded when the first rate hike started, 10-year yields average 1.96%. For some historical perspective on that, since the 80s, they've averaged closer to 6%. This is U.S. 10-year yields. My point, and why I believe that we haven't felt the real punch of these rate hikes yet, is that during that 5-year period, everybody who had borrowing needs had ample opportunity to roll into duration. Now, just picture like one example of someone who's a homeowner, and you had a 3-year ARM, and during that 5-year period, you would have always rolled it into a 30-year mortgage. Now extend that to S&P companies, car loans, everything. Everybody has duration. So as these rates shot higher, so many people can just look back at it and go, wow, it sucks for the next guy who has to borrow at these rates, but I don't have to. If we were in a situation that was different, I think we'd feel the efficacy a little harder. Now, that being said, I think the inflation that's come down has done so because supply chains have healed, and because the federal government is no longer pumping money directly into people's accounts. They're still pumping a lot of money into the system, which is not a great thing to control inflation, but not as much as they used to. So we're seeing the effects of that. At some point in the next few quarters, I think we're going to feel the effects of the Fed rate hikes, and then all of a sudden things could start to get bad from a demand standpoint, recessionary standpoint. Does that make sense, Jimmy?
Yeah, it does. So, but let me ask you, with these higher rates now for initial borrowers, are they locked out? Are they too high? I might have.
Yeah, and that's why I think that people aren't buying homes as much. And I think that the supply is kind of locked up because of it, because nobody wants to part. So, yeah, of course there are many people who are feeling the effects of higher rates. People still have to buy homes, have to move. It's just not the same punch that I thought it would have. Does that make sense?
Yeah, no, totally it does. And so, but let's take it to the next category of commercial real estate, of buildings. These folks that have to refinance now could be in big trouble, right?
Oh, I think they can be in really big trouble. And I think we're just seeing the beginning of that. I think it's going to be a big thing. Again, what I'm trying to say in the most simple terms is that the Fed in normal conditions have an instrument that has a long and variable lag, in the words of Milton Friedman. I think the lag time before we feel it is more so than normal because of it. And again, there are plenty of instances where we're feeling it, but where individual people are feeling it, which means broadly we're feeling it now, but not the same effect as it would normally have. And when it does, and I think there's a chart that I saw today about the amount of debt of S&P companies that's rolling over each year in the next couple of years. It's like only 4%, 5%, 6% in the next few years. But then after that, it's 30% of the debt. That's when it really needs to be rolled over. So that just underscores how long it's going to take for us to feel these hikes in relative to past cycles.
So, okay, so you used the words disinflation and deflation a minute ago. So disinflation is what we kind of want. We want deflation, and our prices in both goods and services both going to come down in that manner.
No, and I threw that in there. I hope for slightly hyperbolic dramatic effect. I do think there's a risk of it, but I don't think that's the base case. I think deflation, disinflation is what we're seeing now, and that's a good and welcome thing. I think that's coming down pretty well. Again, the service part of it, when I see and when I see all these unions arguing for higher paid contracts like the UAW, that's a worry that'll stick around longer than we thought. But I think the force is pushing it down overweigh the other ones.
Okay, well that makes a lot of sense. I know there's a lot of conversation around the idea that maybe this disinflation, that the job that's been done so far has been pretty extraordinary. It's been pretty good.
So let me ask you the question though, do you give credit to the Federal Reserve in the rate hikes, or do you give credit to the things I said? And by the way, I have no problem being disagreed with.
Yeah, no, I mean, I think it's in my opinion, it's both, right? I think it's both in my opinion, and it affects me personally. It does. Now, by the same token, when I go to the grocery store, I'm still spending more money. That's all the same. When I go to the gas station, things kind of settle down a little bit, but I don't see much change there.
Okay, can we talk about the gas part of it real quick, the oil, before we get to the rates, which I think is a fascinating topic? Is that everybody I hear talks about the fact that oil's gone up so much in the last month and a half, and how that's an input cost and it's inflationary, and it is. What we're forgetting though too is at the same time it's also a tax at the pump to a lot of our population and it could be a little bit of a liquidity reducing demand destructor as well. So it's not as clean an equation as everybody wants it to be in crude. Also, I'm glad we have the chart up too, because I think that's a pretty amazing chart. It's obvious to me that level over the last few months, exactly the top of that trend channel, is the level to watch. So I think of settle above that beige area. I think it's off to the races. But I'm watching this chart very closely for a settle above. What's the top of that chart? I've been calling it 84.5.
Yeah, I mean, right now, my area of, again, this is a continuous weekly candle chart for WTI. Yeah. Right. But if you kind of go up to that target wick that we saw last week, that's 84.78. The top of the rectangle is approximately 84 even. So it's pretty keen area resistance. I mean, we've been bumping up against it since November last year.
Right. And it's funny is that, like, I look at this and I see a really, really interesting long opportunity. But on the short term, it's been rejected from that level a couple different times. So there's nothing to say that it can't try to gather steam at this level or even trade lower. So that's why, as a technical trader, and you know this, but just anyone who's watching, you got to wait for your parameters to be met, or else it's just a nothing. This is a nothing to me. Gun to my head, someone said you had to take a position today, might even be a short position, even though I'm looking for the greater long.
So, all right, so let's pivot to fundamentals for a second, a little bit off track, but with China stuck in the mud, is that also going to kind of reduce demand?
I think that's what's happened over the last week. This has been a big deal in China too, and that's why the Aussie dollar is down 6.5% just since mid-July. The last 2 weeks have been tough because the data of China's coming out terrible. They just stopped publishing youth unemployment, leading a bunch of analysts to think that things are much worse in China than we even know. And I think that's one of the reasons that oil was turned around, because there was a good fundamental story. Remember, it was just a month and a half ago that everybody and their mother was predicting the next recession was right around the block. All of a sudden, that's been taken away. So oil's come back on a demand issue too. And then people still keep thinking in the back of their mind about when the federal government is going to call up and say, price on 1 million barrels as they try to refill the SPR. Yeah, that's the Aussie. Look at that decline. That's been hit hard, and that's Aussie trades with two things. Aussie trades in conjunction with their trading partner and neighbor China, and with the price of gold. China's been a bad thing, and that's why the euro's off 3.5% since July 14th. The Aussie's off 6.5% since July 14th. To me, that looks bad. I don't see much of a trade here. Let's go a longer chart. Is there any? I don't have anything on in the Aussie. Let's see. To me, I would
Let's
just say it what's that?
go ahead. I'm pulling up a weekly chart right now, and we'll go back in time.
Yeah, to me, it seems like it's broken through some key support. So I would say it probably heads lower to those October lows. But I see nothing that compels me to pull the trigger now, unless we go to a short term, like 60-minute, we can talk about actually day trading thing. Because if I believe that the overwhelming direction is lower, then I like to try to trade that way, even from a day trading, short term thing. Can we go to like a 60-minute?
Yeah, but in the meantime, refresh us on how this is related to China.
Oh, so China is Australia's biggest trade partner. So if China's doing poorly, the Aussie dollar does poorly. Now, it's funny with these relationships. I know we've talked about on this show before too, is that it doesn't matter if that relationship isn't as advertised. It's what the market thinks it's going to be. It's like crude in Canada. I'm not saying that doesn't really exist, but there are plenty of people who have a chart of crude up and chart of Canadian dollar up at the same time and trade the correlation. So once those correlations exist, they kind of manifest and strengthen themselves over time. So China doing poorly, which we know will drag the Australian dollar down because they sell a lot of stuff to China.
Got it. All right, thank you for that. This is a naked 60-minute candle chart.
Yeah, to me, if I'm day trading it today, I'd have been short it to think that red candle is going to retrace that green candle, but nothing particularly exciting like me saying, "Oh my gosh, this is something I got to be part of." I like the fact that it's the bodies inside on the green candle. To me, means it's gathering steam for a directional move. Yeah. But I think right now it just traces back and forth there. So let's move on to something more interesting then, I guess.
Absolutely.
Can't be trading everything, right? I think the fundamental story is fascinating in Aussie, but I don't see where the trade is right yet.
Right. So I just wanted, again, I know we're talking about yield a lot. I just wanted to show a comparison chart here of the 2, 30, and 10. Mm-hmm. And it seems like the 10 and 2 now are inverted about 65 basis points, give or take.
Correct.
Which is a lot different than 2 weeks ago when we were up at around 98 basis points. Right. Is that a good thing for this recession idea?
I think it's a good thing. I think what it is that when we were trading it, we traded at a 40-year low of negative 108 about six weeks ago, negative 108 basis points. And we've come back quite a bit. And I thought that was the trade, as we remember that the inversion of the yield curve was kind of a belief of what the Fed would have to do with interest rates in the future, plus a belief of what inflation is going to be in the future. And when the yield curve was inverted by 108 basis points, that was painting a pretty grim picture of the Fed easing rates quickly at some point in time and inflation being nowhere to be found beyond the next year or two, which sounds like a good thing. But remember, they don't love, when they worry about deflation. We mentioned that earlier in the show. But anyway, so now that we're seeing the yield curve start to, I hate calling it steepen, because technically it's just flattening back up to zero. But in our world, we call this the steepening move back to zero. And I think that means we're kind of taking out the predictions of a recession. Now, keep in mind this too. If all of a sudden the recession came today and we saw like blow-ups in banks, the curve would probably head towards zero quickly too. But by function of the fact that the Federal Reserve would be pushing short end rates down very, very quickly ahead of long end rates following it down. That makes sense, right? You know what I mean?
Yeah, it totally makes sense for sure. Well, hopefully, the banking system won't break right now. I know there's a lot of discussion with Fitch and some other folks.
I share that. I share that hope too, but I'm just saying that if two different things could cause the yield curve to move towards zero more, what's happening now that we're pulling the recession out and the market believes that rates can stay high for longer, or burning timbers are falling from the ceiling, and the Fed, we believe the Fed has to crush rates on the low end and quickly. So, but either way, I like that trade. The trade the most to me that I want to be in right now is the steepener trade, meeting the 2s versus 10s, heads closer to zero.
Yeah, and we have a new trading vehicle, right? That I learned about it from you this morning on Twitter. I learned it from you on Twitter this morning. Let's talk about that.
I'm quite excited about that. That is, the CME has launched a 2s versus 10 micro yield spread contract. So on that thing I do for the CME, where I do those videos, which I love doing those educational videos for the CME, we've talked about trading the micro 10-year, trading the micro 2-year. We've talked to them as a spread, but prior to this, we had to do it manually. We had to buy the 10s, sell the 2s, or the other way around. Now you can do it as one contract. And when you do it as one contract too, but check my work on this too. I'm 90% sure then that you have individual positions in the micro 10-year and the 2-year. You can trade out of them and it's fungibility. You know what I mean by that, right?
Yeah, I don't know, because they have other spread contracts that are just the contract, so you can't do that.
Forget I said that. When this show goes live, scratch that out. I'm just kidding. I know it's live. Sorry, I said that.
Yeah, but I haven't seen the contract specs yet, so maybe. But no, I don't. I think it's going to be traded as its own standalone contract with the number. So if we're at 65 basis points and you think that's going to go up to 85 basis points, you buy it and you'll sell it at 85. And vice versa.
No, it's negative. So if it's a negative 65 now and you think it's going up to negative 45, you buy it. Right. So exactly. Yeah. But I'm really excited about this contract. And again, that's the trade I want to be in the most. And I've talked about it for a month and I've missed it at every turn, every big move. I talked about it like the day before, and then I get busy doing something else. I forget. All of us, sometimes when you trade too many things, you get confused. But I still think that's a trade. I think the curve's going back to zero.
Yeah, and what excited me there also, if you wanted to trade the difference, right? If you wanted to trade the yield inversion, if you want to call it that, you could do it. You don't have to leg in anymore, right? You wouldn't have to buy 2 years, sell 10-year, or vice versa, which is a more efficient trade. Your transaction costs are less, your commissions are less, and all that stuff.
Yeah, and the commission, not just that, but it's much easier to monitor a stop level. With these contracts, once they launch them, I would never put in a stop that didn't have quite a bit of protection on it, like a stop with like a couple tick band, because you don't want to chase things after they launch, because these products need a little bit of time to mature. But this one I have quite a bit of high hopes for. Yeah,
no, for sure. And I'm assuming it's going to be a monthly, just like the yields. So you'd have to roll if you're holding it for a while.
Right, and that's again, you have great point to make. Those micro yield contracts at CME are all monthly, and to keep positions on month to month, you have to roll.
Yeah, it's easy to do, especially with the NinjaTrader software. Got to make that clear to everybody. So, all right, so let's take a peek at the Fed funds tool. The Fed funds tool is like tracking 85-90% chance of no hike next meeting, but we have almost a third of 33% chance, 1/3 chance that we're going another 25 in November. Is that going to get bigger, that percentage?
I don't think so. I think the last time we saw labor numbers, and which is, remember, the labor, and granted, I know that the retail sales numbers that came in yesterday looked really good. But the last time we saw the labor numbers in the form of non-farm payroll, those numbers to me did not look great. A lot of those jobs added were part-time jobs, second and third jobs, even though it missed on headline anyway. The birth death model still is adding jobs to that, which I think it's backward looking in times where things are turning. I think if we get some bad labor data coming up in the first week of September, I think that odds will change quickly. And I don't think they're going to hike again. And either way, that same Fed funds futures market says that we're going to be easing beginning in just before May of next year.
Yeah, so that some folks are now saying, hey, there's going to be 3 or 4 cuts in 2024. That seems a little optimistic to me.
Well, okay, so you and I are both traders for a long time. I've been taught that everybody has a voice, talking heads all talk, but the market, that's the smart money. So I look at that and it says 100 to 125 basis points cuts between May of next year and the end of next year. I have no choice but to take that seriously. I don't know if I believe that's exactly what's going to be. And I sure as heck know that the Fed keeps talking tough as if they want to keep rates high for a long time. But I do think when things change, we start to see their true colors. And we've seen that in the past. There was a situation back 10 years ago where they were about to embark on a hiking cycle and the NASDAQ punished them by falling 7% in one day. And the next day, I think it was James Bullard came out and said the case for hiking has changed considerably. Well, the only thing that changed is that you saw 7% decline in the stocks in one day. And I think that if pushed, they have not been pushed at all in this cycle, except for the SVB banking thing that was, took about a week or 2 weeks of our time. That's the only time there's been any sort of little glimpse that perhaps they've gone too far. By the way, spoiler, I do think they've gone too far. And by the reasons I laid out earlier, I don't think we felt the effects yet.
Okay. Well, let me ask you this though. So the other thing that's going on, and I don't, this is a dangerous question I'm setting you up for because of who you are, but I'm going to ask it anyway. Is there a seasonal component to Fed behavior in an election year?
Oh God. Yes.
No.
Yes, there is. That's the problem. One of the key problems with the Federal Reserve is that they are subject to report to the politicians. It's a system that does not work.
No, I hear you, but it's a fine line, right? So the fine line is higher rates or lower rates versus labor and how the economy's doing, right? So that's the line that I think has to be focused on in any year, let alone an election.
And inflation as well. I mean, people are tired of paying higher price for stuff, and people don't understand too. There's still a majority of the people are sitting back and waiting for prices to come down. That's not how this works. Disinflation means they go up slower. We don't want a situation where prices go down. I know most people say, wow, that seems stupid, but a period of deflation is actually the real boogeyman. That's what keeps these Fed guys up at night, because if we get into a cycle where people all of a sudden start to pull back consumption because they believe prices are coming down, that can be a very bad reverse feedback loop.
Well, that makes sense, right? So in an ordinary world, you want wages to kind of increase at the same pace or better than inflation increases, because it always increases. Right. But there could be a case where one of those is inverted and it causes that feedback loop.
Sure. And then all of a sudden you get caught in a very bad spot. And that includes the wage price spiral on the upside too, where these unions start to argue for higher wages, and then prices go up because we have to pay them more. And then that's why monkeying with it the way that they do is ridiculous, by the way. But something I want to point out too is that the inflation was intentional. The inflation, and this is not poking at anybody, they told us it was inflation. The inflation was intentional for 20 years. The reason being is they want to encourage people to borrow and buy. That's a dynamic economy. In a perfect world, we would have 2% inflation. And 2% is not an arbitrary number that they pick out like everybody's saying it. What they're basically saying is 3% seems like too much, 1% seems like too little. Let's find a spot in the middle. So you can call that arbitrary, but they want a small amount of inflation to pull consumption forward, as opposed to deflation, which pulls consumption back, and that's a bad thing.
So let me ask you, is that 2% target then going to remain for the next several years? Is that, there's a lot of talk about, well, maybe it should be 3%. Maybe it should be different.
Well, I think what the futures market is telling us is that by spring of next year, we will hit it. I mean, that's the only reason that if the Fed is going to turn around and start easing, which is what the futures market is saying, they're not going to do so casually because they don't want to do it. That it will have to reflect a serious amount of demand destruction before they're going to take that step. And the futures market believes they're going to take that step, and so do I.
All right. Well, we'll keep monitoring. I mean, 2% is the average, right? Which means sometimes you got to be a little below it, sometimes you can be a little above it, but over a long period of time, it's got to average that, and that's a fine tightrope to walk.
There's no doubt about that.
Yeah. Anyway, let me ask you here. We're running out of time, but I do want to get to the stock index futures just because we pretty much follow that most of the time. Let me pull it up here. Give me a second. And I'll just pull up the E-mini S&P, because it seems to be the weakest is the Russell, the strongest is the Dow. The E-mini S&P seems to be the most reasonable. So
right.
we'll pull that up right now. And here, this is a weekly chart. And from our all-time highs to those lows last October, I have a fib retracement on the right-hand side. And we touched that 76.4% almost exactly. And now we're trading between that and the 61.8%. What do you think's happening here?
I think we're in corrective phase for certain. There was a day a couple of weeks ago, it was on a daily chart where we screamed to a higher high, closed at a lower low. And when we gave up that level, I believed we were going lower. I think the bull case for stocks is the extra $2 trillion that's still sloshing around in the system based on COVID. And I've explained that here before, why I believe it's about $2 trillion, whatever. But one of the things that was key to the stock market rally was a belief that the Fed was going to ease. We're pushing that back a little bit. The ease was pushed from March to May. Stocks don't like that. But the third thing was just a strictly a sentiment thing. Buying begets buying, selling begets selling. And when that runs out, you take that away. Now you look at the bear case, which is margin compression from inflation. Even Target today said that, there's bad numbers of the retailer, bad predictions going forward. I know their stock rallied 8%, and that's a function of the fact that it had the crap beaten out of it for so many months. But I think that the bear case for stocks is fine. Again, the fundamental case each way, I don't care that much. I'm more of a technical trader, but the more we trade below 45 even, where are we at now? 44.60-ish? Is that what that says?
44.60, yeah.
Yeah, the more we trade below that, the worse I think it is. And I believe the correction comes back to 4,200, which would be about 10%. You see all that congestion that's there underneath? That's why I like that.
So so you're pretty good with the option stuff, right? So is 44, a lot of folks are saying, hey, we started closing on a weekly below 44 even, 4,400 even, then that's going to reinforce this idea of the market moving down.
That's what I do. And again, that's when I will increase my position. But the option thing you said, which remember, option volatility was so low up until 3 weeks ago, trading in the 13s and the VIX. And I took that opportunity to put on these trades where I would sell a put in the SPY or in the futures at like about 4,400. At the time, it was about 5% under the market, and then buy 3 more puts, like 8% out of the market. So it was a 1-by-3 spread. My belief, and it has worked a tiny bit so far, is that when we start to go lower, vol will increase, but also the skew will increase. So those puts I own that are more out of the money should increase the extrinsic value disproportionately to the ones I sold at 4,400. Do you think the average viewer on this understands that? Because if not, I mean, I can explain it on Twitter if someone wants to contact me.
Well, the average viewer will. I don't know that I will, but no, that's a good point though. Yeah, for sure. We had Brett Kachuba on from Spot Gamma on Wednesday at another show, and we're trying to stay contemporary with our options play. We are kind of up against time right now, but I do want to comment. I hate you used the word correction, and I told Bobby this. My hair gets on fire when people use correction because the market's never incorrect. It could be in a bearish state. It could be a retracement. It could be in a bullish state. I'm sorry. I just had to. I had to.
No, I'll change. I'll change my vocabulary. I like that. It needs to retrace to knock out some of the weak longs who started to not respect risk, and all of a sudden, when risk goes against them, we have to trim the hedges a little bit to make it more of a healthy rally. I don't think it's any sort of end of the world bearish move. But I won't call it a correction anymore out of respect to you, Jim.
You can call me incorrect. That's fine. I can get that.
Yes, I have been. Right.
Anyway, all right, man. Thanks. How could folks get a hold of you and see your good work? Because I love the podcast. I love all the stuff you guys are doing.
Thank you so much. At Jim Urio on Twitter, JIMIUORIO. The podcast is called The Futures Edge. We release it on Twitter. It's also on Spotify and on Apple and an iHeart and all the different services.
Oh, you could listen to it on Twitter now.
That's correct. Yeah, we put it out on Twitter too.
Okay. All right. That's good. That's super convenient. Good to know. All right. So you're out there. You're moving it around. I love those as well as your CME videos.
Thank you so much. I really appreciate it, Jim.
Yeah, you do some.
I do, yeah.
So that's good.
Yeah.
Anyway,
thank you very much.
Again, thanks for being here. Everybody who was joining us today live, and for folks looking at the recording, appreciate you being here. Remember, most important message of the day, please, be safe out there. Be good to each other. Thank you.